our star of the week is Celestica, symbol CLS on both the TSX and as well as the New York Stock Exchange. Celestica delivers innovative supply chain solutions to global customers through two segments: Advanced Technology Solutions, or ATS, and Connectivity and Cloud Solutions, or CCS. The ATS segment serves aerospace and defense, industrial, health tech, semiconductor, display, and robotics. The CCS segment serves communications and server and storage businesses. The stock is up a whopping 123% over just the past 6 months, putting the price at 35.50 Canadian, a price it has not seen since 2002. So me and Brennan were babies back then. So why is the stock finally seeing a substantial increase after 20 years of stagnation? The company saw a major jump after its fiscal Q2 2023 earnings in late July. The company reported a strong revenue growth of 13% for the year to $1.94 billion, with increased operating margin of 5.5% from 4.8% and adjusted EPS increasing to 55 cents from 44 cents. A strong increase from top to bottom. The growth comes from a couple of factors that normalized supply chains over the past year, especially for its aerospace and defense market. It was really a return across the entire industry. It was very weak in that 2020 to 2022, and we finally seen a reversal in that aerospace and defense market. As well, they saw strong growth from its hyperscaler data center customers, driven by the surge in AI and machine learning, which has seen increased demand for proprietary computer solutions. Further on top of the great results, the company raised its 2023 outlook to revenue of $7.85 billion from $7.6 billion and an adjusted EPS of $2.25 compared to a range of $2 to $2.05, which they initiated at the start of the year. So about 10% increase from what their expectations were at the start of the year. As well, the company anticipates 10% or more adjusted EPS growth for fiscal 2024, which is the same as calendar 2024, which is roughly $2.50 per share, which would put the valuation for the company about 10 times its 2024 adjusted earnings. So as a whole, really, Celestica has really just had a great year of growth. Not only has it been able to meet its expectations, but it's been able to move them up. The company reports its Q3 earnings later this week, so we'll be able to see if it's able to continue its trend of from top to bottom growth, with that margin actually staying above really 5%. But either way, for now, it's our star of the week.
Awesome. Who wants to comment on that? I was staring at space during the whole thing, so I missed it. Oh, Aaron wants to, but he's muted. I'm just kidding. I was watching Aaron talk, and you're muted, Aaron.
Okay, I think I'm unmuted now.
There you go.
No, a couple points that I will make about the company. One, it is a low margin business, so net profit margin in that 5% range. Historically as well, the revenue growth has been very inconsistent. So great growth this year, strong revenue growth last year. In the 3 years before that, really flat to like a slight downward trend in revenue. So I think, talking, if one were to have a conversation with management, we would want to know, what has changed about the company, or are you just basically in the good part of the cycle right now? And once that cycle ends, you're gonna see negative revenue growth.
Yeah, it would be certainly good to know that, because there is something that has changed, whether it be end markets right now, end market demand, but in the last couple of years, a real surge in terms of revenues and profitability in the business. So those would be reasons, we'd want to talk to the management and figure out what has changed. Can that continue? Because if it can, then there is potential for a longer term move in the stock. If it is something that is one time in nature, there's where we'd be wary, obviously. Or if it had some market conditions that were more just to that period. So, those are the things that we'd look at. Again, look at what the backlog is in the business too as well.